The IRS just released their 2026 inflation-adjusted tax brackets and other changes to the tax code. Great thing is, today we're gonna walk through all the changes that are applicable to you. I've reviewed the thousands of pages of tax code so you don't have to, and we're gonna break this down into 4 key areas. We're gonna talk about the new tax brackets for single filers. We're gonna talk about the new tax brackets for married couples. We're gonna talk about the changes to state and local taxes, as well as capital gains rates. This is all key areas for you to make sure that you understand so you can pay the least amount in taxes. If that all sounds good to you, let's dive into today's video. If we hadn't had a chance to meet, my name is Luke Turner. I am the co-founder of Moment Private Wealth. We help business owners make smarter decisions with their money. If you haven't already, please subscribe to the channel below. There's gonna be more and more content just like this that we're putting out there. So let's dive into our first topic today, which is our 2026 tax brackets for single filers. Everyone loves to talk about tax brackets. And if you think about tax brackets, the bookends of our tax brackets are 10% being our lowest tax bracket and 37% being our highest tax bracket. But if we expand that out in between, we have all these different tax brackets. We have the 10% bracket, the 12%, 22, 24, 32, 35, and 37% brackets. And what I want to encourage you to be thinking about is think about these like buckets. And these buckets are going to be getting filled up over time. But one big misconception in the tax code is that I hear people say this all the time. I'm in the 37% bracket, so I'm paying almost 40% in taxes on every dollar I make. And that's just simply not true. So let's educate you around how those tax brackets work. First up, let's check out our buckets here. So our first bracket is our 10% bracket, which means that for the first $12,400, you're gonna get taxed at 10%. Now, the 12% bracket goes from that 12.4 number all the way up to 50,400. Then we see our first big jump from our 12% bracket to our 22% bracket. From our 12% bracket all the way up to 105,700, we're gonna pay 22%. Then up to 201,755, we're gonna pay 24%. And now we see another big jump where we go into our 32% bracket, all the way up to 256,000, and then all the way up to our 37% bracket, which is gonna be 640,600. Okay, so that's our single brackets. Now let's check out our married filing jointly brackets. And I think this is important to point out because a lot of people have this misconception that getting married doesn't save you money on taxes. And let me tell you, it actually does save you a lot of money on taxes. And this is shown right here as it looks at these tax rates. So just like the tax brackets for single filers, I want you to think about the married filing jointly brackets in terms of those buckets. So let's look at each of our buckets from 10% all the way to 37%. First up, our 10% bracket. On our first 24,800, we're gonna pay 10%. Then on our next up to 100,800, we're gonna pay 12%. And then we see that big jump from 12 to 22, where we're gonna pay 22% all the way up to 211,400. Then on the 24% bracket, 403,550. And then again, we see that big jump to the 32% bracket on 403,550 all the way up to 512,450. And then all the way up to our top tax bracket is 37%, anything over 768,700. So how does this actually play out, and how does this actually help us coming into 2026 versus 2025? And I just want to show you guys an example that shows you the difference between our 2025 brackets and our 2026 brackets. So let's look at this example. So in 2025, our 12% bracket is all the way up to $96,950. Okay, but our 12% bracket in 2026 is gonna go up to $100,800. Okay, so what does that mean for you? Well, what that means is that there's about an extra $4,000 that you're gonna be keeping in your 12% bracket before you jump to that 22% bracket, that first big jump that we just talked about. Okay, but in reality, that's gonna save you about 10% in actual tax liability on that $400,000. Okay, so this one example right here is gonna save you about $400 in taxes. And that's a big impact for a lot of people as I think about tax brackets and how it could affect you in both the short term and in the long term. Okay, so we've talked through the different tax brackets for single filers as well as for married couples. Next topic that we're gonna dive into here are the different deductions that you can take. And we're gonna start out by talking about the standard deductions for the main 3 groups of households when you go to file your tax returns. We have head of household, we have single filers, and we have married filing jointly. So let's dive into this graphic where we're gonna talk through each of those areas. So first up is the single filers. You can see that we're gonna pay we're gonna get to deduct about $15,750 from our taxes in 2025. As head of household, we're gonna be able to deduct $23,625. And for married filers, we're gonna be able to deduct $31,500. Now, what is the big change from an inflation adjusted that we're gonna see in 2026? So what we're gonna see is that in 2026, single filers are gonna be able to deduct $16,100, head of household $24,145, and then married couples about $32,200. So a big jump for all of these folks, and it's gonna save you guys some real money in taxes. So let's look at an example that's gonna demonstrate this for you guys. So as I think about the standard deduction, it's really important to make sure that we understand how does the standard deduction work and how is this actually going to save you money on taxes. Let's go ahead and assume the standard deduction for married filing jointly. So the first step we're going to look at on the left-hand side is our 2026 numbers. So that means that we're going to be able to deduct $32,200. If we assume that we're in the 37% tax bracket, this is going to reduce our taxes by about $11,914. Amazing. But how does that compare to 2025? Look at the standard deduction in 2025. We have about $31,500 that you're gonna be able to deduct this year. If we're in the 37% bracket, that's about $11,655 in savings. But the delta or the difference here is $259. So it's something very important for us to be considering whenever we're thinking about these tax strategies, is understanding what the actual benefit is. So that's a big difference for a lot of people. It's something important that you should be educated around. The next piece as it relates to deductions that we need to be talking about here are the SALT deduction, or state and local taxes. So when we think about the SALT deduction, one of the biggest things that had changed in the tax code back before the big beautiful bill, back before the original Trump tax changes, you could deduct as much of state and local tax as you wanted. But with the original law that came out with Trump, we were capped at $10,000, meaning that you could only deduct federally $10,000 of your state and local taxes. So if you paid $100,000 to the state of California because you're making $1 million in income, you could only deduct $10,000. But that's all changed now, and this could be a big benefit for you. What this means is that before the big beautiful bill, as you can see on this page, we are capped at about $10,000. But with these changes, it's gonna increase from $10,000 all the way up to $40,000. Okay, this is a big difference that we need to be mindful of when we're doing tax planning, and it's a great opportunity for folks in high income tax states to be able to deduct more on their taxes. So now that we've talked about the different deductions that are out there that are changing based on the 2026 tax law, let's transition and talk a little bit about capital gains. And in this capital gains section, we're gonna talk about what are capital gains, as well as what are some of these rates that have changed going into 2026. So first up, what is a capital gain? In the simplest form, a capital gain is when you buy something, let's assume for $5, it grows to be worth $10 and then you sell it. That's a capital gain. Okay, the easiest example is in the stock market. If you bought a stock for $5, it's worth 10 now. That delta, the 10 versus the 5, you're going to pay capital gains tax on it. But the tricky part about capital gains is that capital gains have two different ways that they're taxed. Okay, so let's look at another chart where it's going to outline these different ways that it's taxed. So on the short-term capital gains, this is the first way that we're going to look at it. And this is for anything that you sell that you held for less than 1 year. Okay, if it's held for less than 1 year, you're going to have to pay ordinary income tax rates on all those dollars. So if we rewound this video back to our tax brackets we were just talking about, those are the tax brackets that you're gonna have to get taxed at. Those can be awfully higher than our long-term tax brackets, which we're gonna talk about here in a sec. So on our long-term tax brackets, the way you qualify for these special tax rates that save you a lot of money on taxes, you have to hold it for over 1 year. So a big thing that we're always looking at for clients is how can we make sure we're pushing things into that long-term tax bracket versus our short-term tax bracket. So when we think about our long-term tax rates as a whole, how does this actually play out over the course of time? And what we're going to look at here are what are the tax rates for long-term capital gains for single filers versus married filing jointly. There are three tax rates that we need to be looking at for long-term capital gains: the 0% rate, the 15% rate, and the 20% rate. One important thing to be thinking about here is that when you're going to calculate this for you personally, first you need to account for how much ordinary income you've made. Think about how much money you've made from work, and then your capital gains are going to go on top of that. Okay, so when you go to calculate how much you're going to have in the 0%, the 15, or the 20%, you first need to calculate how much ordinary income rates you have. So let's look at this. From an individual's perspective, at a 0% rate, you're gonna pay no tax on the first $49,450. This is a great place to jump in here to reference exactly what I was just talking about. let's say you made $50,000 in wages from your job. That would mean that right away, any capital gains that you took would automatically jump into the 15% bracket because your first $49,450 would get taxed at 0%, got eaten up by your ordinary income brackets. Okay, the next 15% is going to get taxed up to $306,850, and then anything over that's going to get taxed at 20%. Now, a key here is to be thinking about our top ordinary income bracket is 37%, but our top capital gains tax bracket is only 20%. So we need to be really mindful of if we're going to take long-term or short-term capital gains. And then the last piece here is just looking at the income brackets for married couples. So those same rates apply, 0, 15, and 20, but much higher limits. So on the first $98,900, you're going to pay 0% in taxes. On the next, all the way up to $613,700, you're going to pay 15%, and then over that, you're going to pay 20%. So what's the moral of the story here as it relates to 2026 tax changes? Well, the reality is that we need to be in a position that we are planning for the future, and we're taking into account these inflation-adjusted 2026 numbers. Okay, if you have questions around tax planning, you have questions around anything related to personal finance, there's going to be a link in the description below. Please reach out. Happy to have a conversation with you. Additionally, please subscribe to this channel. We're going to be putting out more and more content just like this, and I hope you enjoyed the video today. Thanks.